Welcome everyone, and thanks so much for joining us today. My name is Steve with the Snap Projections Customer Success Team. I'm joined as well by Anu and Lee, who will be helping me throughout the session to answer your questions. If anyone in chat can, or anyone in the webinar can go to the question panel and just let me know if you can hear me okay and see my screen all right, that would be greatly appreciated, and then we can get started with today's session. And while I'm just waiting on that, if you do have any questions during today's webinar, please feel free to submit them. Thanks so much, David. Please feel free to submit them through this same portal. So from the GoToWebinar control panel, you can click on the question mark and then submit questions. We will try our best to get to them live during today's session. If we're not able to get to them live, we will get back to you within the next few days by email, just to make sure that you have the answers and information you need. Today's webinar is going to be focused on retirement drawdown strategies and really getting the most out of your clients' money in their retirement. We're going to review the survey results. So we sent out a survey with the invite to today's webinar, and we really appreciate everyone that's already been able to complete that survey. So we'll look through some of the results. We're also going to discuss a few of the research papers available from the FP Canada Research Foundation. So they've done some work on retirement drawdown choices, as well as CPP, QPP timing decisions. So we'll review those and then include them in some planning work that we'll do. And then we'll show you how to model different drawdown strategies in SNAP by creating different scenarios and then comparing those scenarios across key metrics like the client's after-tax spending ability, their estate values, and other key information. And then at the end of today's session, we'll leave about 15 minutes for questions in case we haven't had a chance to get to them throughout the session, but we will be answering questions as we go. So please feel free to submit those at any time. All right, so as I mentioned, we got about 60 responses to our survey, which was terrific, and really appreciate everyone taking the 5-10 minutes to submit that feedback. We were able to get some information about how people are currently planning for decumulation and drawdown strategies. I'll start at a very high level, kind of talking about decumulation and what that typically means. So decumulation is the idea of using all of a client's resources, whether that's pension income, government benefits, assets, home equity, using that in order to help them to achieve their goals throughout a period of time. So in this case, we asked what metrics people rely on when making decumulation strategy decisions. A lot of people rely on marginal tax rates, OAS clawback, and the client's goals. So those were the three most common reference points or input values, if you will. And then people are, of course, interested in the client's life expectancy as a factor into the decumulation. Rates of return can impact the plan, whether that's changing over time once they retire, if they're going to reduce their risk and reduce their return assumptions, that can have an impact on the plan. It may also have an impact on the plan if there are different rate of return assumptions across different accounts. So if a non-reg is invested in GICs and the RSP is a balanced portfolio, then sometimes where you're drawing money from can have an impact on the growth rate for the remainder of the plan. And then similar, same sort of idea with asset allocation and whether that differs between account types and over the length of the projection. And then about half of the respondents consider use of home equity in the plan as a key input. We also had an other field where people could give additional values that they found relevant. So one is the withdrawal rate. So the idea of comparing a client's total withdrawals relative to their available capital assets can be a useful reference point. Another idea was use of inheritance. So whether a client is expecting an inheritance, how does that adjust or impact the recommended decumulation strategy? And then there's also the effective tax rate as another reference point in addition to the marginal tax rate. When we asked how people are typically making recommendations for decumulation, the majority are doing that on a per client basis. So looking at the client's unique goals, their current financial situation, and then tailoring the plan to what's going to be best suited for their specific situation. That is, of course, the recommended best practice is to always tailor the strategy to an individual client. It's possible that if you're working with the same sort of client profiles and they all have similar goals, you may find that you're recommending the same strategies over and over again. But we do want to just make sure that each time that we're making a recommended decumulation approach, that's going to be the best approach for that particular client. Other rules of thumbs or best practices include registered withdrawals up to a set marginal tax rate. There's also the idea of deferring registered withdrawals as long as possible. This is actually the default drawdown algorithm that's pre-built into SNAP projections. So we use a tax deferral strategy in order to use up non-registered money that is going to have a tax drag on the investment returns. We use that as soon as possible and then prolong the length of the TFSA and registered accounts that have tax-free growth. Then another idea is often taking registered withdrawals up to the OAS clawback threshold. So we'll talk a bit about these different strategies, how you can compare them, and how you can ultimately find the best approach for your client. And then we mentioned the FP Canada research paper into retirement drawdown choices, and about a third of our respondents had come across the research previously. In terms of takeaways, a lot of people mentioned that it really reaffirmed their existing approach and thinking around decumulation. So not necessarily new ideas, but another reference point that advisors can use either to share with their clients or as a backup in terms of being more confident in the recommendations that they're making. Others mentioned the importance of tailoring the plan to each client. So that was emphasized throughout the research paper. And in a similar way, the need to avoid rules of thumb. So, while we can use those as starting points, we'll often want to check different strategies for each client and see which one is optimal. And then another comment was about how the available TFSA room can have a huge impact on the optimal drawdown, because if you are able to put some of that money into a TFSA, then that would be more beneficial than if there's no TFSA room available. So we'll go over all of that. We'll also reference some of the functionality throughout SNAP. So if you have any questions about functionality that you see today, or you have any questions about a plan that you're currently working on, you can always go to help in the top right corner of the software, click on Help Center, and access all of our articles, webinars, our What's New article. You can also get our telephone number and send us an email directly. Our customer success team is always here and happy to help. So please, if you ever don't have an answer to your question, let us know and we'll get back to you as soon as we can. With all of that, we'll jump into the software and start to create some financial projections and compare what the optimal situation will be for our particular client. So I'm going to go into SNAP projections. I'm going to create a new client. Our client today is Sonia Hayes, and she was born 1959, and she currently lives in Alberta. I'll give a bit of background on Sonia's current situation. She's currently employed in her final year of work. She's 64 years old, planning to retire at the start of next year. And we're going to be creating a series of financial plans to answer her 4 questions that she's come to us with. So she's looking to understand when she should be taking CPP and OAS. She wants to know what the best order to withdraw from her different investment accounts is. She wants to know whether to use the home equity that she has in the plan and how she can do that. And then she wants to know, given all of the assumptions and the recommendations that we'll make, what is the maximum retirement spending that she can achieve? So again, we'll go through a series of scenarios in order to answer each of these confidently and provide her with the rationale. In order to do that, we'll just need to start with a base projection. So we'll input all of the known information for Sonia. We're going to assume that she retires next year at age 65. We'll run the projection until age 100. We'll start off with the FP Canada guideline assumptions, and then we'll adjust those for the expected investment management fees. So we'll just reduce those slightly to get a net of fee expected return for each asset category. For income, she's currently earning $125,000. You'll see that we've recently added a few new input options to the income entry page, you can now index your incomes directly from this section of the scenario setup. By default, we put that as 0 just to be conservative, but you have a few options available. You can either set a custom percentage. So if I wanted to index her employment income at 1%, I can do that here. If she's expecting a 3% increase each year, we can enter that value. And if I want, I can actually delete the value from the field, and that will link our income to the general inflation rate. So whatever the planned inflation assumption is, our income will just increase at that rate each year. I'm setting this as employment type so that the software will automatically deduct CPP and EI premiums. We're also setting it as taxable by default so that Snap can take off the appropriate amount of tax and then earn additional RSP room. We've also added the ability to customize the start and end age for income. So you can now make adjustments to your incomes right from the input page instead of needing to go to the planning page in order to customize those values. So in this case, the software just defaults the employment income to start in the first year and run until the year before they retire. As always, we can add additional incomes. There's nothing else for us to consider for Sonia's case and no pension to add. So I'm going to click next and go to her assets page. We'll see here that there's a default non-reg added to the projection. This is so that Snap can deposit excess cash flow in the future into some sort of capital asset. So if you're going to add a non-reg of the client's own, you can delete this holding account, but we do always recommend having a non-registered capital asset in the projection in case there's ever excess money from something like a home sale or RIF minimums being forced out of the account. For Sonia, we'll add a $200,000 non-registered account invested as 40% fixed income and 60% equity. We'll also add an TFSA for 100,000 and an RSP for 600,000. Across the top of the account table, you can see that there's additional tabs that we have the option of customizing if and when needed. So if I click TFSA, you'll see the starting contribution assumption for 2023. In this case, we'll leave it as is because Sonia has used up all of her previous room and has not yet made her contribution for 2023. So we'll leave this value. For the RRSP contribution room, we're going to update this based off of her most recent notice of assessment. So she has 30,000 of available contribution room. We can further customize things like the conversion age when we move the RSP to a RIF. We'll talk more about that later. And then we can customize settings for the DCPP Lira LIF. We could unlock the account if they're eligible for their jurisdiction, and we can control the conversion age there as well. And then we can add employer matching if a client has a group retirement plan. I'll go back to the assets table and then scroll to the real asset section to add in her home. So she has a $750,000 home that she originally paid $400,000 for. So that's everything for her asset base. We'll click next to go to debts. She has paid off her mortgage and has no outstanding line of credit or other debts. So we'll click next and go to government benefits. By default, Snap assumes that the client is going to receive 55% of the maximum. This is the national average benefit received. So we conservatively pre-fill that into the plan. Once you know a bit more about your client's employment history, you can adjust this for their expected benefit. So I'm going to assume that based off of her employment history and her level of income, that she'll receive about 80% of the maximum. And so Snap will calculate that for me and enter in the expected pension value. For OAS, we'll leave that as the base assumption of 100%. On the left, you'll see that we do have additional pages that we could use in this plan. We could add insurance policies. We could conduct life needs analysis if we wanted to see if more life insurance is needed. We could also add an RESP, a corporation, or adjust further settings to customize the plan. But for now, we're just going to click planning pages in order to get started on answering Sonia's list of questions. So here we have all of that input information coming together to show us Sonia's life on one single page. If we look at the left, we have the year and age for each year of the projection. We also have how much Sonia is spending on her personal lifestyle expenses, things like groceries, transportation, everything that's left over after considering debt, investment contributions, insurance premiums, and things entered elsewhere in the software. We have the employment income. SNAP is taking off the appropriate amount of CPP and EI. It's taking off the appropriate amount of taxes. We can see the value of her investment accounts each year, her home, and then estate information. So I'm just going to make a few minor adjustments to the planning page, and then we'll be set to start answering Sonia's questions. The first thing I'll do is enter a $6,500 contribution to the tax-free savings account. And then I'll enter $22,500 to the RRSP. And you'll see that as I make these changes, the plan is not updating in real time. The run scenario button turns red, meaning that I've made changes that haven't yet been applied through the calculations. So once I'm ready and I've made all the changes I want to for the plan, I'll click run scenario and that will recalculate the whole sheet for me. I'll then come to the real spending goal in the first year of retirement and we'll enter in $54,000 a year and copy that down to the bottom of the plan. So this is how much she wants to spend each year of retirement. So after I click run scenario, we can see that SNAP automatically indexes that forward throughout the projection at the rate of inflation that I've input. If we look to the right, we can see that SNAP is automatically withdrawing the non-registered money out of the withdrawing non-registered money in order to supplement the CPP and OAS payments to reach Sonia's $55,000 a year spending goal. So all of that's happening automatically for us. Once the non-reg runs out, SNAP starts taking the TFSA money, then the RIF minimum kicks in, and that continues all the way down to age 95, which is when Sonia is projected to start running out of money. If we want to, we can also review that in chart form. So you can see her assets gradually deplete throughout retirement, and then she runs into a shortfall and starts borrowing in the last 5 years of the plan. We can also see on the after-tax spending chart, this red shortfall section. That means she's run out of money and can't quite meet her spending goal. If we compare the total debt taken out, which is about $400,000, it's really about 25% of her home equity value. So she has a home worth $1.6 million at that point in the plan. So this plan could still work for Sonia. She could use a home equity line of credit or a reverse mortgage, or she could downsize or sell the home and move into assisted living or something of that sort. So there's still lots of levers available for us to pull, and we'll talk more about that throughout today's session. But with that, we've been able to create our base projection for Sonia, and we're ready to start moving forward with answering her questions. Before I do, I just want to pause for a moment and see if there have been any questions come in related to this first plan.
Hi, Steve. Yeah, we've had a few questions, kind of specific ones that I'm trying to answer over text. So yeah, keep asking your questions, and it's just hard to know which ones to go into because I know you have a lot to cover today. So
yeah,
yeah,
that's fair. Okay, so no pressing questions at this point. We'll likely tackle lots of them as we progress, and then towards the end, we can always revisit questions that have come up. So this is our first projection for Sonia. We'll update the title of it to Scenario 1, Base Case with Shortfall at age 95. So we can go to Sonia, say, based off of our current assumptions, our simplified drawdown, and our CPP and OAS starting at 65, you're expected to run out of money at age 95, but you'll have lots of equity in the home that we can leverage in order to make sure that you are able to meet those last few years of spending. So let's jump to Sonia's list of questions and we can start tackling the first one on the list. Before we actually start creating the plan, what I want to emphasize is the importance of understanding the client's goal. So for Sonia, she's a single individual with no specific beneficiary and no specific estate goals. So she is really focused on finding the plan that is going to minimize the chance that she runs out of money before she passes away. So when we start going through the alternate scenarios and talking about what recommendations to make for her, we always want to bring it back to that idea of maximizing the life of her assets or minimizing the chance that she runs out early. She's not focused on her estate goals, she's focused on longevity. So with that in mind, we'll go back to the first scenario, copy the plan, and start creating an alternate scenario to talk about CPP and OAS timing. So we'll create scenario 2, defer CPP and OAS. There is a great research paper from the FP Canada Research Foundation that went into the benefits of deferring CPP QPP benefits. And it also talks about the behavioral considerations that clients might have when it comes to this decision, because there's both the math component as well as the behavioral side of client preferences, beliefs, and behaviors. So we want to factor both of those in when we're making recommendations to our clients, because if they're not going to take a recommendation to defer, we don't want to base the rest of the projection off of that assumption that they are going to defer. So I would encourage you, I've actually added this research to the handouts section of the webinar today. So if you go to the GoToWebinar control panel, under the handouts section, you should be able to download 2 PDF files. They're both also available from the FP Canada Research Foundation's website, and one goes into CPP timing decisions and the other goes into retirement drawdown choices. The main takeaway, to summarize the QPP paper, is that the majority of clients in Canada are best off deferring CPP as long as they can. So the benefit of the deferral increase is significant and on average benefits them by about $100,000 by deferring in it as long as they can, as long as they have the cash available in other sources to see them through that 5-year period. Then you'd want to recommend that clients defer, unless they have unique health or other circumstances at play. Starting with an assumption of deferral is typically the best place to begin. So if we do that, we can go to scenario setup and then government benefits, and we can change the CPP start age in this case to 70. And you'll see that SNAP automatically increases the benefit by the expected adjustment for deferring. So you don't have to do anything further. You would just change the start age, and then it'll base the increase off of what was previously entered for if they were starting at age 65. If we go back to the planning pages, we can now see that for the first 5 years of the plan, there are no CPP benefits, and then it starts at an increased value as of age 70 and continues down throughout the plan. And by deferring CPP, we have delayed the time that she runs out of money by 2 years. So we've pushed that off by 2 years and made it so that the shortfall only starts as of age 97. We've also reduced the total debt that she's expected to need to take out from 400,000 down to 200,000 by deferring CPP. So right away, we can demonstrate the advantage of deferring and talk about how this plan is more likely to help Sonia reach her goal of minimizing the chance of outliving her money. If we scroll back up to the top, we can see how SNAP is now adjusting the plan around that CPP deferral. So SNAP is taking more money out of the non-registered account in order to meet her cash flow needs for that period. And it's starting to take a bit out of the RRSP in order to take out money tax-free during the period while it can. So you'll see that this is a unique optimization in the software to try and take out registered money in years of no taxable income. We can now go back into scenario setup, go to the government benefits, and then see whether it's also advantageous to defer OAS. So we'll defer it to 70. We can see that the increase has been automatically done by SNAP. And then we can go back to the planning pages. So now you'll see OAS has been deferred by 5 years. As we scroll down, we're now running out of money as of age 98. So we started at 95, pushed that out to 97 through deferring CPP, and now we've pushed it to 98 by deferring OAS. So we've made this plan a little bit better, specifically for Sonia's goals. If we scroll back up, we can reference some of the numbers that were included in the survey and talked about earlier around the marginal tax rate. So we can see that there's not really a spike in marginal tax rates throughout the projection. Starts off at a low rate of 25% and then increases slightly once the RIF minimum starts being forced out. We can see that there's no expected OAS clawback in this plan. If there was OAS clawback, we would see a column just to the right of this one that shows the total clawback expected, and the OAS column would also be reduced by that amount. So in this case, we're getting full OAS, we're not having spikes in marginal tax rates. So these are some of the indications that would suggest that this may still be worthwhile for Sonia to proceed with this strategy. What we can also do is talk about, well, why wouldn't everyone defer CPP? If it's this clear cut, why doesn't everyone do it? Might be Sonia's question or might be your question. And so we can actually reference how the plans compare to one another over time throughout the projection. So at age 70 in 2029, if we scroll to the right and look at the estate before tax value, in this plan, it's showing 1.7 million as her estate before tax. We can also see that there's about a $323,000 tax bill that's expected, which would bring her final estate to 1.385 million. So if we compare that to this scenario where she didn't defer CPP and OAS, we can see that at age 70, her estate would be higher if she starts CPP and OAS at 65. It makes sense because she hasn't had a chance in this scenario to start benefiting from the deferral increase. But again, coming back to Sonia's specific goals, she's not worried about her estate at all throughout the projection, let alone at age 70. So this, while it's a factor for some clients, wouldn't be an impact on Sonia's decision about whether to defer or not. But we can see, and you can use this sort of comparison for other client scenarios to help them make the decision about which approach is going to be better. If we move forward to age 90 in 2049 and do the same comparison, looking at the estate value, we'll now see that it's flipped. So now it's 60,000 higher in the case that she deferred because she's had a chance to recoup the CPP and OAS that was not taken for the first 5 years, and she's actually made up for it through the increased benefit. So this is a really crucial tool when comparing plans and trying to find the best recommended approach. So I'll jump back to Sonia's list of questions here. So her first question, when should she take CPP and OAS? Based off of her specific goals and her current financial situation, we'd recommend deferring CPP and OAS to age 70. Her next question is about where should she be taking her money from? So we'll go back into Snap, create an alternate scenario. So we'll copy this base scenario and we'll continue to build upon it. So this will be scenario 3. We're going to defer CPP and OAS and use an alternate drawdown strategy. So once again, we'll look at the drawdown default that Snap has created for us right out the gate. So we have non-registered money coming out. This is in order to get rid of this taxable return that's currently in the plan. So there's a bit of a tax drag on this investment return. So by using up the non-reg first, we're able to defer the use of the TFSA and the RIF advantaged accounts because there's no taxes on the growth. Snap is taking a bit out of the RSP in order to move them up to where they would start to pay taxes each year. So it's getting money out completely tax-free in this particular situation. Then it continues on with its non-registered TFSA registered priority of withdrawals. So when the non-reg runs out, it moves over to the TFSA. And then once the RIF minimum begins, we can see that that's coming out and supplemented by the TFSA. So you may be wondering, could we do an alternate strategy? We can quickly compare different approaches. So right now, we're building up a shortfall of about 114,000 in this plan, given the current strategy. If I change the drawdown strategy to an alternate, say registered, non-registered TFSA, I can run this scenario, see how those withdrawals would differ. So now we're taking registered money right away, then we're taking non-registered, and then tax-free money. And now, as a result of the change, we're running out of money at age 97, and we're building up a total shortfall of 177,000. So this would be less ideal than the default that we were just looking at. So we can quickly compare different strategies this way. We can also switch back to the default, and we can use what are called overrides in order to blend withdrawals throughout the plan. So maybe I want to try taking $30,000 a year from the registered account until the client turns 72 and is forced to start taking the minimum. So we've overridden the registered account to take 30,000 a year. When I run the scenario, SNAP is now going to take a little bit less out of the non-registered. We can see that's now prolonging the non-reg money in the plan. And then if we scroll down to the bottom, we've improved the projection slightly. We've gone from a shortfall of 100,000 down to 70,000. So we've improved the plan by about $30,000 worth. So this would suggest that some sort of blending of non-registered and registered money for the first few years of the plan, followed by RIF minimums and supplementing non-reg and TFSAs, is the best approach for Sonia, given that she's going to defer CPP and OAS. One additional way that we can apply this strategy is, instead of manually withdrawing registered money, we could actually go into scenario setup, and then under that RSP tab I mentioned earlier, we could simply convert the registered money into RIF money at age 64, so that SNAP automatically takes the minimum required each year of the plan. So now if we scroll down to the bottom, we can see that this has further improved the plan by about $10,000. We're now only short by 60,000 total. So this will be our recommended approach for Sonia. We're building upon the deferral of CPP and OAS by recommending that she convert her RSP to a RIF as of retirement, taking the minimum required, supplementing it with non-reg, and then eventually using up the tax-free savings account later on in the projection. And sorry, this should be, there we go. So non-registered, then TFSA, and then registered. And this should make the plan that much better. So if I scroll all the way down, now we're only short by 26,000. So we're going registered money, then the RIF minimum is going to kick in. We'll continue to supplement with non-reg, and then we'll finish off with the TFSA money. So we've now created a fairly optimal plan for Sonia. We can go back to her list of questions and recommend that she make those plans in terms of converting her RSP to a RIF and taking a blend of registered and non-registered money, specifically because she's going to have very low taxable income and she has a very small balance of non-registered money relative to the size of her registered account. So again, I'll pause there, see if there have been any questions that came up throughout the last few minutes.
Thanks, Steve. Let's see. Yeah, definitely. There's been a few more questions, but related specifically to this, there was you talked about the inflation, the general inflation rate for the income right at the beginning there, and you just remind everyone, that's because that's brand new now, how you would, using this general page, we've got our general inflation rate here, and then if you have an income, the new feature is now that you can actually index that employment income with the general inflation rate. I think by default, it will be a 0%. Like if you added a new income, you would see 0%. And if you wanted to get it back to general inflation, you just delete that. And it would just a placeholder there to show you that it will be using the general inflation from your general page. Awesome.
Exactly.
Thanks.
Yep, no problem. Awesome. All right, so we've done our third scenario in order to answer Sonia's second question. Now she wants to know whether and how to use her home equity in the plan. And before we do that, I just wanted to jump back to the retirement drawdown research that was done, again, by FB Canada Research Foundation. So we just talked quite a bit about different drawdown strategies, whether to take registered money first or last, whether to use the TFSA first or last, whether to do accelerated RIF. This paper did a great job of kind of summarizing the pros and cons of different approaches, summarizing the importance of knowing your client's goals and how different strategies will impact those goals. We will talk a bit more about comparing different strategies once we're done the 5 plans for Sonia, but really this paper kind of goes more in depth on some of the main takeaways are that as a default starting point, a lot of clients will be best off deferring registered money as long as possible. The reason that there's a bit of an exception in this case are for 2 causes. One is the fact that we're deferring CPP and OAS, and there's no other taxable income in this plan during that period. So if Sonia had a defined benefit pension plan, or if she had a significant $1 million non-reg portfolio that was generating taxable income, it may be the case that we'd still want to defer RIF as long as possible. But in this case, with no taxable income and very little non-registered money to use up, by deferring or by taking RIF early, in this particular case, that is advantageous. But it does talk about some of the trade-offs and what to look for in your plans when you are comparing different scenarios. So what I'll do now is I'll copy this scenario and we'll talk about using home equity in the plan. So this will be scenario 4 with home equity. And we're going to do the home equity through a downsizing illustration. So if we go to help in the top right, there are lots of different strategies that you might want to implement for home equity. You could use a HELOC. So there's an article here, home equity line of credit, how to use. You could do downsizing. So here we have an article that outlines how to model downsizing, which is what we'll go through now. So anytime that you have a question about a topic, you can come to the help site, search in key terms, and then find what you're looking for. And if you ever can't, that's a great time to give us a call, send us an email, and we'll be able to help. So to model a downsizing scenario, right now we have the home being projected all the way throughout the projection, all the way to the end. I'm going to go to scenario setup and then assets. And then I'm going to sell the home as of age 75. So if we go sell home age 75, when I go back to the planning page, you'll see that the home is now ending as of the year that she turned 75, and there's a large deposit to the TFSA and the non-registered account. So in this case, we don't want to use all of the proceeds because we're going to buy a new property. So we're going to assume that she needs about 700,000 for the next property purchase, which will leave about 242,000 left over for investment. So if I go back to the assets page, I'll add a new home for 700,000, and that will be purchased at age 75. So now we can see as of the year that they sell the home, they buy a new one for 700, and then the difference of roughly 200,000 gets deposited across the TFSA and the non-registered account. Now, if we scroll down to the bottom, we can see that she has quite a bit of capital assets still left over in the plan. So she's no longer in a shortfall. She actually has surplus projected, and she still owns her home. The new home that she purchases worth about 1.1 million. So there's a couple options that we have available here. One thing that comes to mind when we see the TFSA contribution from the home deposit is that each year of her plan, she has new TFSA room building up that SNAP is tracking and then using once it has excess cash flow. If we wanted, we could actually use that contribution on an ongoing basis by entering in as a continuous contribution in order to pull extra money from the non-registered account and deposit into the tax-free savings. So now we can continue to top up the TFSA and make the plan even more tax efficient. So you'll see SNAP is taking extra money out of the non-registered in order to do that. And then once again, once we have this new balance in the non-reg, we could choose to make contributions into the TFSA, and we could do that until we expect the non-registered to run out. Oops, I must have indexed that. Go. So we would only want to continue the contributions until the TFSA runs out of money, or sorry, until the non-registered runs out of money. So now we can show money being pulled out of the non-reg, going into the TFSA, and making the plan that much more tax optimal. A few things that you can do, because the contribution room is expected to increase over time with inflation, this 6,500 would actually increase over time. We can kind of shortcut that by entering in a large contribution of 10,000 and copying that down until our desired age. So I've entered 10,000, but when I hit run scenario, Snap is going to replace that with the inflation adjusted contribution amount. So you'll see it's replaced my 10,000 with 7,000 and then 7,500 as the maximum is expected to increase. So if you want to be conservative, you can just assume 6,500 will continue on. If you'd like to model the increase for inflation, you can do that shortcut of entering in 10,000 and copying it down. I'll do the same thing here and copy that down. And at the end, we can actually see that 10,000 is expected to be more than what would be available, or sorry, we're expected to have more than 10,000 available. And so we can enter in 15,000 and then Snap will replace it with the maximum. There we go. So some final optimizations that can be done in the software in order to move money from the non-reg into the TFSA. We are constantly making further enhancements to the software. This is one of the sorts of automations that we're looking to make in the future. So for the time being, you can do this through the steps that we've outlined here. And we are looking at ways that we can continue to automate these types of steps to make the planning process simple and quick.
I have a couple questions for you, Steve, if you don't mind,
Yeah.
just kind of based on that. So one question is tracking TFSA contribution room. So when there are withdrawals that are being made, just to confirm that we're tracking that, because we'll then allow higher contributions to make up for that in the future.
Exactly. So if I were to take out 100,000 this year, right before the home sale, so if I take 100,000 out, you'll see that my contribution the next year jumps by that 100,000 amount. So Snap is tracking any withdrawals and adding that back to the contribution room the next year, in addition to the expected annual increase. And in any year of the plan, if you hover your mouse over top of the contribution value, you'll see in the pop-up box how much room the plan is assuming is available as of that year of the plan.
Great. And then kind of on similar lines, just about TFSA contributions. So just maybe you can just kind of slowly go over again. How does it know where the money's going to come from to make those TFSA contributions? Right now, non-registered, but what if you wanted it to come from registered?
Yeah, so right now, Snap is simply following the withdrawal order of the software. So at the start of the year, Snap looks to see how much cash flow it needs to generate in this year of the plan. So for 2024, Snap needs to generate 55,134 of lifestyle spending plus a contribution of 6,500 to the TFSA. So it knows that out the gate. Then it says, where am I going to take that money from? It goes to the withdrawal order column and it says, I'm going to take it first from the non-registered, then from the tax-free savings, then from the registered. In this case, we've already converted the RSP to a RIF. So this minimum value will come out no matter what. And Snap will then take the remaining 37,000 needed from the non-registered account. If we wanted to solely use registered money to fund the tax-free savings, then we could change the order so that it showed like this, and we would have just the full amount coming out of the registered account. If you wanted to, you could also override a withdrawal from the non-reg. So if you wanted to take all of the client's lifestyle spending needs from the registered, but you want to top up the TFSA coming out of the non-registered, you can enter a manual withdrawal in order to offset the contribution going into the TFSA. So there's a couple different options, but really the primary focus is following the cash flow management order for the year.
That's great. And then of course, if they had enough income, they wouldn't even have to withdraw from the non-registered. For example, if they had an inheritance coming in or something like that. It would
Correct,
just take
yes,
it from that cash that's coming in.
exactly.
All right, thank you.
Awesome, yeah, thanks for all the questions. So I'll do one final scenario. We're gonna copy this plan. We'll update this to scenario 5, and we'll call this sustainable spending. So if we go back to Sonia's list of questions, we've shown her how she could use home equity in the plan through downsizing. And now her question is, if she were to take all of the advice that we've provided, defer CPP OAS, start RIF minimums at retirement, and then downsize at age 75, what's the maximum that she could spend without depleting the capital asset portion of her projection by the end of the plan? So in order to do that, I'll go to the recommendations tool in the top right, and then we'll see that right now the goal is overfunded by about 577,000. That's how much is left at the end of the plan right now. So we can click calculate under the sustainable spending tool, and that's going to increase our spending to 58,000 a year in order to use up all of the capital assets in the projection. So right now we've been able to increase her spending by about 5,000 above her initial goal by making various recommendations and showing her how she can use some of the home equity to supplement her retirement spending. So that's been us able to address all of Sonia's questions during today's session. I will open it up for any broader questions or anything else that you'd like to see during today's session. If there aren't any pressing questions, I do have one more example that we can go through as a way to talk more about optimizing plans, comparing scenarios, and what to consider when doing that.
Yeah, why don't you go through that example, Steve, and then we know we have the rest of the time for some questions.
Perfect. Okay, so if we go back to Sonia's first plan, so we have base case with shortfalls. So here we were starting CPP and OAS at age 65, and Sonia was running out of money at age 95. We saw that by taking the RSP money later, she was, if we change the withdrawal order to take registered money first, so if we go in and we change the RSP conversion age and go back to the planning page, as we scroll down, we can see that that has deferred her shortfall by 1 year, and it's reduced her total shortfall in the plan. So in this set of financial circumstances, with this amount of non-reg, TFSA, and RSP, she's best off taking her RSP early, right? We can see that because she has such little non-registered money and very little taxable income, she's better off starting RIF at retirement. But if we were to copy this scenario and change her financial circumstances, say through an inheritance, we can show that the same sort of strategy might not be preferred. So we'll go base scenario with inheritance. So we'll go to income. We'll add a new income called inheritance for 1 million. And we'll just set that for 1 year at age 65. So at age 65, she's going to receive $1 million non-taxable, and that's going to be allocated across her plan. So now there's money going to the non-reg. She's topping up her TFSA for the year. And now she has this fairly sizable non-registered account that's going to be creating taxable income. So if we go to the taxable income, now we can see as of 2025, there's roughly $30,000 of taxable investment income in the projection because of the non-registered. So if we scroll to the bottom of the page, we can see that she would have about 4.2 million left in the final year of this projection, and she would owe about 91,000 in taxes, bringing her final estate to 4.1 million. If I copy this scenario and call this scenario 7, and this time we're going to defer RSP, which is really all that I'm doing here is I'm putting it back to the default that SNAP follows and the default approach that the research paper out of FP Canada Research Foundation suggested. So in this case, we are deferring registered as long as possible. We're using up non-registered as soon as possible in the plan. And then if required, we would be using the tax-free savings account. So by changing that strategy, if I scroll to the bottom, we can see that in this case, she's actually better off with the default defer RSP strategy versus the start RIF early. In the first case, we wanted to start RIF early because she had such a small balance of non-registered money and such a low level of taxable income. In this new financial circumstance case, with more taxable income and more non-registered money to use up, she's better off deferring RIF as long as possible. So once again, it comes back to the idea of tailoring each plan to your unique client's financial situation and their goals. So that would be kind of the main takeaway, hopefully, of this these illustrations. So with that, I'll open it right up for questions. We've got about 9 minutes left if anyone has anything they'd like to see modeled.
All right, Steve. Okay, just a couple general questions about new features, and I just thought it's exciting to talk about. We've had a few people ask about expenses and how to model lump sum expenses, and we're actually just in the process of testing out a new feature that will be coming soon for that. So I just wanted to let everyone know that. Keep an eye out. Coming soon, the ability to do that. A little bit easier than the way we do it now, but there is an article you can find under our help site that's all about how to do that, how to add expenses.
Yeah.
But it will be easier soon. Okay.
Yeah.
The other one is about comparing scenarios. So I think at the very beginning, Steve, you showed how you can choose any given year to compare a scenario, like the final capital and estate summary.
Mm-hmm.
So right now, this is the comparison that we have available, but we did just have a survey recently for all of our clients to ask them what's important to you to compare between different scenarios. And so we're going through all that data now, and we'll be designing something to help improve the ability to compare scenarios and compare other things. So just want to let you know about that as well. The reports that you've attached the reports from the FP Canada, like the study, right, Steve, to this webinar. So you can grab
Yes.
them under the handouts, but they are from the FP Canada Research Foundation. So you can go to you could do a Google search and find them online as well. I also wanted to point out that Steve wrote a great article recently about creating an optimal financial plan and talking a little bit about the default strategies that Snap Projections uses, and then how you can optimize that potentially for your specific client. So why do we choose the default withdrawal order that we do? We talk about that in this article and give you some ideas here about, I guess, fine-tuning that specific scenario for that specific client. So this is a great article to refer to. Actually, I'm just going to share that with everyone in the chat here. And the other article that might be helpful is under the Start Here category, we have a toolkit. And in this article, there is a checklist. So some things that you might want to think about once you've created the basic plan. Things like, did you consider, I don't know, OAS clawback, or just things to check in your projection. So you can download that and take a look and just see here different things to think of, because there are a lot of things to think about. So we did want to provide you with something to refer back to. And this toolkit also, at the very bottom of the toolkit article, we've just added a link to our blog. So the Snap Projections blog. We have a lot of information there as well. And I just want to make sure that people were aware of everything that you could find here. So most recently, we posted about encouraging maybe younger people to get engaged with financial planning. Maybe there's some pushback there that they don't think they need a plan because they're still young, but how beneficial it can be to show even just a change of savings over 20 years can make a big difference. So yeah, this is also available for you. Just going to take a look through the questions here and see what else has come in here since I've been talking. Okay, quick question about why would you want to put a default non-registered account in every scenario? Why do we have that when you first create a client?
Yeah, great question. So maybe I'll very quickly create a sample client. So if I create a sample client and I have very basic information, and then in retirement, let's say that they're receiving CPP and OAS, but they only have a $20,000 a year spending goal, or to be safe, let's just do 10,000. So if the client has 10,000 a year that they want to be spending, if that's less than their available sources of income, then Snap will calculate the excess available and it'll deposit it to that default non-registered account. So you can see here, Snap is just putting the excess money expected into this capital asset so that you have a reference of how much extra would be available and what you might want to do with that. Do they want to increase their spending? Would they want to put this into a TFSA or an RSP? So having this bucket, if you will, for the software to put money into is an efficient way to build the plan. If we don't have that in the projection, if I delete this from the plan and there's no non-registered asset in the projection, what will happen is Snap is still going to calculate the surplus, but now it has nowhere to put it. There's no capital assets, there's no spending to do other than the 10,000. So it puts the excess in this, or it indicates the excess in this net cash flow column, and then it deposits the money into a cash balance temporary holding bucket. And then it continues to do that throughout the plan. So it just puts the excess into this cash balance so that you know how much excess is expected throughout the projection. And you can certainly leave this in the plan if you truly want. Our recommendation is to kind of address it either by adding capital assets or increasing the client's spending so that the surplus is not being retained in the plan. And you can do that in a couple of different ways. We could simply increase the spending to the sustainable level so that the software is using up all of this surplus that's being calculated. The other option would be to turn the cash flow management off in the plan. So if you turn off the cash flow management, now we don't actually have a spending target. Snap is just going to spend all of the money available each year of the plan. There's going to be no surplus calculated and nothing to put into non-registered accounts. So this would be how you can get rid of Snap saving excess money, would be to just assume that everything gets spent each year of the projection. So again, there's a couple of different options to address these types of situations. And if you ever have questions about a specific plan that you're working on, you can send us an email or give us a call and we can take a look and talk about the best approach for your case.
Thanks, Steve. One quick thing about sustainable scenarios. I just wanted to point out that right now we're doing a consistent spend for every single year with a sustainable scenario. You also have the option to start that sustainable in a later year. So you could do a higher spending earlier and then choose to run sustainable starting a bit later. So in like 10 years after retirement, for example. So here Steve started off, he knew that 60,000 was higher than their consistent spending for every single year. So that's going to be higher than whatever the sustainable will calculate for us now. So under the sustainable spending, just click that blue age and change it to a later year, and then you can calculate a new sustainable value starting from that later year. So this way you can have a bit of a laddered approach. So it's available as a manual process. We don't have a sustainable where you'd say, show me a higher spending for the first 10 years and then like a laddered one, but you can do it manually by using this functionality. And thanks so much for all the questions that have come in. I know the last few ones that have come in, especially, we haven't had a chance to get back to yet. So we will be replying back to you as soon as we can. As I guess we're at time.
Yeah, flew by. Yeah, so thank you everyone for joining. Really appreciate the participation in the survey. It helps us to gain insights about how the software is being used and helps us prepare for these sessions. If you do have any feedback about today's session or the software in general, please respond to the email that we'll be sending out shortly. We really appreciate your feedback, and that's what drives all of the work that we do. So it helps us to understand what is and is not working for you. But with that, thanks again for joining us, and we'll see you in the next one.
Bye, everybody.